So if you're wondering who all these people are, well, they are stock market investors who are busy eroding their wealth. Yes, they are the people who do not have basic knowledge of investing in stock markets, and instead of growing their money, they have actually lost more money. So if you don't want to be one of them, don't make the mistakes that they have made. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. This video is going to be a very quick and simple guide to what all you should not do while investing in the stock market. So as a beginner, it becomes even more important for you to be aware of these most common mistakes made by stock market investors so that you don't end up like them. So let's begin with the most crucial one, trying to time the market. Meet India's top 3 unluckiest investors, Amar, Akbar and Anthony. Amar used to invest in the Nifty 50 index every month diligently. Now Nifty 50 is an index that tracks the performance of our country's biggest 50 companies. Coming back to Amar. But his sense of timing was so bad that all his money got invested at the peak of the stock market every month. But surprisingly, when we checked Amar's CAGR as in annual returns over the 15-year period, it came out to be decent 13%. Now, Akbar used to invest once every quarter, but unfortunately, just like Amar, his investments also always got invested at the highest level of Nifty 50 in that quarter. But his 15-year CAGR came out to be 12.2%. And finally, we have Anthony, who used to invest once every year, and he too always invested at the highest level of Nifty 50, which gave him a CAGR return of 11.4%. So you see how close their returns are. Now look at the chart on your screen. It shows the SIP returns during the well-known 2008 market crash. So if somebody had started SIPing during the then peaks and the bottom of the stock market, the returns today would have hardly been any different. During the recent COVID crash, you will see a similar pattern. So if you are a long-term investor, timing the market does not matter. Instead, focus on being a disciplined investor. Moving to the next mistake, investing too low. So suppose Amar and Akbar invested in a stock a year ago. Both made similar 12% returns. But Amar was not so sure and was little apprehensive. So he invested a lower sum of 10,000 rupees. Whereas Akbar made a thoughtful investment of 1 lakh. So Amar made a profit of 1200 rupees and Akbar made a profit of 12,000. And Anthony, who invested 5 lakhs, made a profit of 12% too, which comes out to be 60,000 rupees. So while all three made the same percentage of returns, but you see how the amount matters. A profit of 1200 in 1 year doesn't seem to make much of a difference. But when you see 60,000 as profit, it looks like that you have earned decent money. So how much you invest matters, but how to decide how much is a good decent amount to invest? Well, so suppose you have 1 lakh to invest, but you are confused and you invest only 10,000 or 20,000 out of it, and the remaining amount kept lying idle. It means you are investing low. So be sure not to keep your money idle. Then another most common kind of mistake is tips-based investing or investing based on FOMO. Tips-based investing can slowly and steadily wipe out your entire capital. Tips often come without the necessary research and understanding of the investment's fundamentals. And you never know that the tips can be a part of scams and frauds designed to manipulate stock prices. So don't fall for fear of missing out, FOMO. Just because your friend or colleagues have made some money in stocks selected basis some tips, you don't need to get into them. Then how to invest? This takes us to the next mistake. So keep things simple. Now, while you should do your research, go through company financials, but all this comes later. As a beginner, if I have to tell you one way to select a stock, I would say go for a company which you understand. Don't try to complicate things. We often hear terms like multi-bagger stocks, finding a hidden gem. I know they sound fascinating, but let me tell you as a fresher, it is always better to stick to companies whose businesses you understand. After all, you are not investing to impress others. Then, coming to another very interesting mistake is being stubborn with a stock even if it is in a falling trajectory. Many times investors tend to become emotional. Even if they have made a loss in a certain stock, they won't exit it. Instead, they would become stubborn to recover the loss from that stock itself. In fact, they add more money to a falling stock to average down the cost of price. But what such investors don't understand is that while they are wasting their time in a stock whose price is falling, there are many other stocks that would have grown multiple times during that same time period. So, wiser decision would be to move out of that stock and invest that money in some other stocks which are performing better and recover your losses. Now, if you have also fallen in love with some bad stocks and are trying to recover your money in the same stock, do let me know in the comment section. Moving to the next mistake. While investing in stocks, most people forget the basic principle of investing, that is on the basis of one's risk appetite. Now, what is risk appetite? So imagine a new driver who is very careful, always sticking to the rules and driving slowly. This is like someone with a low risk appetite who prefers safe choices when it comes to money. On the other hand, an experienced driver might be more willing to take a few risks like driving a bit faster or trying new routes. Similarly, someone with a high risk appetite is more okay with taking chances with their investments, hoping for bigger rewards even if there is more uncertainty. So you must select stocks as per your risk tolerance level. And if you are wondering how to know your risk profile, well, you can do that very easily on the ET Money app by taking the Investor Personality Assessment. It will ask you to answer a few questions which hardly takes a few minutes, and you'll get to know your risk profile. That concludes this video. Have you encountered any notable pitfalls during your stock market investments? Remember to share your experiences in the comments below. Your insights could benefit others. Hope you liked this video. Don't forget to share it with others and do like and subscribe to our channel. We'll be back with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.